Hello everyone, welcome to my Next Gen Trades YouTube channel. Are you confused about stock market indices? Let's break it down. They're not. Think of them like traffic reports for the stock market. Just as traffic reports give you an idea of how busy the roads are, stock market indices give you an idea of how well a group of stocks is doing. Just like traffic reports tell you how congested a road is, stock market indices tell you how a group of stocks is performing. They aggregate the performance of selected stocks to give you a broader picture. Instead of cars, we're looking at stocks. Each stock in the index represents a company, and its performance affects the overall index. Instead of speed limits, we're looking at prices. The prices of these stocks fluctuate based on market conditions, and the index reflects these changes. An index tracks the overall movement of these stocks, giving you a snapshot of the market. It helps investors understand the general direction of the market without needing to analyze each stock individually. Why do we need this? Because tracking every single stock would be overwhelming and time-consuming. Indices simplify things, giving us a benchmark to measure market health. They provide a quick and easy way to gauge the market's performance. By looking at indices, investors can make informed decisions about their investments. They can compare the performance of their portfolio against the index to see if they are doing better or worse than the market. So next time you hear about stock market indices, remember, they're just like traffic reports for stocks, helping you navigate the financial roads with ease. In India, we have two big players, the S&P BSE Sensex and the NSE's Nifty 50. Think of them as captains of their teams. The Sensex, run by the Bombay Stock Exchange, BSE, has 30 of the biggest, most actively traded stocks in India. The Nifty 50, run by the National Stock Exchange, NSE, tracks, you guessed it, 50 top companies. These indices are like the barometers of the Indian stock market. When they go up, the market is usually doing well. When they go down, it's a sign that investors are worried. So indices are cool, but what can you actually do with them? Lots. Firstly, they're benchmarks. Let's say your individual stocks went up 5%, but the Nifty only went up 2%. That tells you that your stocks outperformed the market. This is a great way to measure your investment performance against a broader market. Secondly, you can actually trade indices. Yep, just like stocks, you can buy and sell index funds. These funds are designed to mimic the performance of a specific index, allowing you to invest in a wide range of companies with a single purchase. These funds track the performance of an index, giving you diversified exposure to the market. This means you don't have to pick individual stocks. Instead, you can invest in a whole sector or market. Finally, indices help with hedging. Hedging is a strategy used to offset potential losses in your investments. Worried about a market downturn? You can use index derivatives to protect your portfolio. Index derivatives, like futures and options, allow you to bet on the direction of an index. If you think the market will go down, you can use these tools to potentially profit from that decline, or at least mitigate your losses. Indices are like the Swiss Army knives of the investment world, versatile and useful. They offer a range of functionalities, from benchmarking and trading to hedging, making them indispensable tools for any investor. Whether you're a novice or a seasoned trader, understanding and utilizing indices can significantly enhance your investment strategy. How do you choose which companies go into an index? It's not random. There's a method to the madness. Most indices, including the Sensex and Nifty, use something called free float market capitalization. But what exactly does that mean? Think of a company like a cake. Imagine you have a delicious cake in front of you. Market capitalization is the total value of the cake. It's like saying, this entire cake is worth a certain amount of money. But not all of the cake is available to eat, right? Some slices might be reserved for special guests or kept aside for later. Free float refers to the portion of the cake that's actually available for trading on the stock market. It's the part that anyone can come and take a slice from. In the stock market, this means the shares that are available for the public to buy and sell. Shares held by insiders, like company executives or major stakeholders, are not part of the free float. So, a company like Reliance Industries, with a huge free float market cap, will have a bigger influence on the index compared to a smaller company. This is because more of its shares are available for trading, making it more significant in the market. Understanding free float market cap helps investors gauge the true market influence of a company. It's a crucial factor in determining the weight of a company in an index. So next time you look at an index, remember, it's not just about the total market cap, but the free float market cap that really counts. This helps ensure that the index reflects the most actively traded and influential companies in the market. Section 5. Zeroing in sector-specific indices. Want to zoom in on a specific sector? That's where sector-specific indices come in. Let's say you're bullish on Indian banks. Instead of tracking the entire market, you can follow the Nifty Bank index. It tracks the performance of the top banking stocks listed on the NSE. Similarly, we have the CNX IT index for technology, the Nifty Pharma index for pharmaceuticals, and many more. These specialized indices give you a focused view of how different sectors are performing. Section 6. Beyond the Big Two. More Indian indices. While the Sensex and Nifty are the most popular, India has a whole bunch of other indices too. There's the BSE Mid-Cap Index for mid-sized companies, the Nifty Small Cap Index for smaller companies, and even the Nifty Sharia Index for Sharia-compliant investments. Each index caters to a specific investment strategy or market segment. Remember, the index you choose depends on your individual investment goals and risk appetite. Section 7. Indices around the world. India isn't alone in this index game. Every major stock market in the world has its own set of indices. In the US, there's the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. These indices track the performance of the US stock market. By comparing indices from different countries, investors can get a sense of how the global economy is doing. Section 8. The bottom line. Your index guide. So there you have it, folks. Stock market indices. Your guide to understanding the stock market. Remember, they're benchmarks, trading tools, and sector indicators all rolled into one. Whether you're a seasoned investor or just starting out, understanding indices is crucial for making informed investment decisions. Now, go forth and conquer the markets. Don't forget to like and subscribe if you liked the video.